Hi guys, this is KEL, and it's been a long time I do a video because I'm so busy overseas. But today is the most comprehensive 2025 summary that you really need to watch. The market, Dow Jones, the Nasdaq, the S&P 500 most likely will fall by 10 to 15% by January to February period. There's a good reason for that. I'll share with you more because I believe that Jerome Powell, all right, will not cut interest rate for 2026. And I have many things to share with you. Let's go into details right now. But before that, disclaimer apply as usual, guys. Do your risk assessment. Now, one thing to note, why gold and silver shot up and came down recently? Now, I've been very bullish on gold for the longest of time, right? I've been telling you guys this, gold should be going up higher and went all the way up itself. That was good. But of course, the gold, when it went up itself, was a little bit too fast, too quick. So what's the reason for that? Well, apparently, gold went up for a good reason. And the reason is kind of stunning because gold actually went up because we have a lot of short selling in the market on the silver side. Apparently, Bank of America, Citibank, they shot a net short of $4.4 billion worth of silver. And that's why basically that pushes the gold market at the same time going up. And silver from $25 went to $50, one of the highest level in human mankind history, goes to 80. So you look at the numbers, right? 25 to 50 is $25. So you flip by one time, it was $75. So basically the target levels are 75. And of course, right now we have the news coming in from Chicago Mercantile Exchange. They are looking at to increase the margins requirement, and it's only going to hit again today. Apparently, there will be another margin, what they call extension, increment, and that will be on 31st of December today. So that's the reason why you can see now gold and silver is coming down again despite yesterday recovery, right? So all these are coming in. The question is this, why are these two banks holding so much shorts? That's something very interesting. All right, now the next thing is this Bitcoin. We know that many people are involved in Bitcoin, and as a matter of fact, the whales came in very heavy. They bought $5 billion of Bitcoin recently, and that basically usually will push the market higher, right? Because we've seen this before when the whale came in, the Bitcoin flew up. Okay, but what's happening right now? Apparently, it's not happening. So this is something that is very worrying. Because imagine if everybody is buying Bitcoin and it's not moving in, that means that there's a very high chance something bad could actually happen. And of course of that, we can see right now on Bitcoin, I'm looking at my chart right now very clearly. I think that Bitcoin has two directions. Now, if the $5 billion kick in, we could see the Bitcoin flying up all the way to $102,000. Okay, so that is the upside. But if you ask me, when the whole world is buying and the market is not moving, and you can see that there were many rallies that came in and it basically fizzled off by the end of the day. Now, this is definitely distribution and not accumulation. And my KSI indicator, my big boys indicator, this tells me the boys are selling. So my personal take is this, the moving average right now at 88,257 is going to be a very instrumental area. If the Bitcoin fail to stay above this number, there's a very high chance Bitcoin could nosedive down to 80,700. And honestly, I'm putting my little bet over here. I believe that Bitcoin will come down. So it won't be happening this 2 days, definitely for sure this New Year Day. But who knows, in the weekend where the volume is light, that could be a trigger. So guys, if you want to put some buy limit order, you can try to buy somewhere around there, but of course, do your risk assessment, yeah? So this is my personal view on Bitcoin in the coming weeks, all right? Now, one thing to note, the treasury yields, this is going to be very exciting, guys. Now, the treasury yields tell us something very incredible. Let's take a look. Now, we have shared this before many moons ago. Every time when the 10-year, this have the yield inverted, right? Between the 10 and 22 year, okay, you can see that was where it came down, all right, the inversion, and then now it recovered, right? So every time when this happens, you can see that we will have a recession. So that is the reason why I kind of believe that we're going to see recession kicking in next year. All right, it'll likely be a technical recession. Same thing again, the market will just get spooked for a while, and the Federal Reserve will come in to save the day by printing more money. But when will they print? They'll print in May. Now, why May itself? There's a good reason for that. The reason is because Jerome Powell will step down. Very high chance he'll step down, that's for sure. And then we have a big issue right now. Let's go to the summary for 2025. Now, unemployment has hit the highest level. It came at 4.6. Okay, that's high. And of course, one thing to note, the inflation is still at 3%, well above the 2% Fed target. And the worst thing is this: if the Fed doesn't cut interest rate, the recession will kick in, right? But if they cut interest rates, then of course we will have inflation with a weak labor market that will usually be a recession. So all this tells you that they're in a trap position, and I believe that Jerome Powell will not do anything. Okay, likely he will just hang on his position and then wait until May where he exit and get someone come in. Now, one thing to note, it happened before in 1970 where inflation went up, unemployment gone up, and the growth was stagnant. And after that itself, the Federal Reserve back then hiked interest rate, and of course, to crash inflation, and it killed the market for a long time. I don't think this will happen under Donald Trump, but I believe that he'll get someone to cut interest rate massively. So let's take a look at this chart from 1970s onwards. Yeah, this is something very incredible. That's why today this chart is this MAO is going to be very good. You must watch it. Okay, so you can see that this is the US 10-year bonds versus the Federal Reserve and the S&P 500. The S&P 500 is the one in purple. The one in the candlesticks is the US bonds yield, and then the Fed funds is the one in blue. Okay, so very simple, right? Usually we can see the pattern, right? When the Fed fund rates and the 10-year yield hits the same direction, it will fall together, right? You can see that quite beautiful. All right, so one thing to note, when this happened, okay, when the Fed fund cuts rates and the bond yields comes down, that's definitely for sure, the S&P 500 also comes off, all right? So it happened before in year 2000, and then after that, in later part in 2007 and 8, where Lehman crisis happened, same thing again, the Federal Reserve cut interest rate, the yield came down, the stock market came off, all right? So pretty understand, right? And it happened again in 2019 during the COVID period, whereby we see the same thing again, the Federal Reserve cut interest rate, the yield came off, and the stock market came off, all right? So very clear. But the thing is this right now, we can see that the Federal Reserve has cut interest rates. The yield is not moving, and the stock market is flying up. This is totally not the same. Somehow this whole thing is broken, and I can only tell you this is because of the liquidity the Federal Reserve have been adding over the last 2 years. And when that comes to a point whereby it gets crazy, you have inflation. That's what's happening right now. And when that inflation happens, people losing their jobs, this is going to come as a very bad potential technical recession. And we all know that it's very clear now the Fed chair candidate, Kevin Hansett, is likely going to be the next Federal Reserve chief. Why did I say that? Because, be honest, look at his face. This is my personal view. Look at him. This is a very typical guy of a yes man, in my opinion. Now, the thing is this, what he said in this article from CNBC really made me feel that he's just literally mimicking what Donald Trump said. Let's look at the central bank around us. The US is way behind the curve in terms of lowering rates. Now, this is basically coming from the White House economic advisor, and apparently itself, Kevin also agrees on that. And the thing is this, the US economy now is at 4.3%, although it's faster than the consensus. But the thing is this, he is saying that Donald Trump is the one that basically helps this thing. But we all know that this 4.3% GDP growth is really not a real number, because there's a lot of numbers are being not inside this report. So you can see this chart later on, the market is not reacting to it. And of course, hence, there's a close call here. In fact, 3 Fed governors voted against the quarter point move in this recent December, the most dissent since 2019. That means that majority of them usually will have the same direction, and then they'll call for the same way on the interest rate. But this time now, 3 Fed governors against it. And in fact, it was mentioned that the decision was a quarter point, was a close call, meaning they almost didn't cut interest rate in December. Now, the market went up because of December rate cut. Okay, the market was really expecting that. And imagine if they didn't do that. So the question is this right now. If they were so close call back in December, then it's a very high chance in January they will not do that. And that's the reason why I feel that in January, February, there will be a pullback in the market. As a matter of fact, now Donald Trump says last week that he will announce the nominee for the Fed chair, and he will pick someone who believes in lower interest rate by a lot. And Kevin Hansett, definitely in my books, is the one he will pick. All right, so let's take a look right now at the Fed fund rates probability. Let me bring you the chart right in. Now you can see that we are 28 days away from the next FOMC meeting. And based on the numbers right now in January, the Fed fund now is at 3.5 to 3.75. And in fact, the market is also looking at the same number, okay, the same number for January interest rate. So that means that there'll be no rate cut expected, all right? So something that the market may not like it, and that's why profit taking will likely happen. Now, for March itself, apparently, there are more people believe that there will be a rate cut of 44%, but 48.5%, the majority still thinks that there'll be no rate cut. Now, imagine this, if this is to stay on, the market will definitely shake, the market will take profit, and that's something that you need to take note of. Yeah, very, very important. Now, one thing to note, when you have a poor businessman, the son example, it's like a example. You can see that, but your dad can print money, he can save you from the back door, and this is what's happening right now. The Federal Reserve has pumped in a lot more money again. The Federal Reserve has pumped in more money into the market. Basically, itself, 16 billion was pumped in. This is the second largest liquidity injection since COVID. And why are they pumping in money? Your guess is as good as mine. So things are really not doing well right now. So imagine this, Jerome Powell being in the office for so many years, I think he knows the answer very well. So that's the reason why I don't think he'll do anything. As a matter of fact, right now, why is it so scary? Because the Shiller P index now is at 40, the second time in history since 1880s until now that we are really at the high level. The last time was the dot-com bubble, which the market break down very badly, right? So the question is this, with all these numbers telling you, why would you want to bet on the market when it's expensive? Now, this is the Dow Jones S&P crash indicator, something I took from internet. Take a look here yourself. I'm not going to say too much, but it's very, very clear there is a very high chance of a potential capitulation going to hit the market. So my personal take is this: January, February, likelihood this will happen. But after that, the market will be a buy. I repeat, listen to me again. If the market pulls back, after that, it will be a buy. Because why? When the next guy come in, the next Fed chairman come in, he will cut interest rate, and that will buoy the market again to new record high. So this is where we can consider to do a short selling based on your rules, and then when the market comes to the bottom, buy over here itself. Okay, so this is my personal take in the long run. Okay, for next year, 2026, and of course, there's a very interesting thing happening right now. The hedge funds are very bearish on the yen. Now, we all know that the yen is a very important carry trade for a lot of people. And with the yen interest, with the BOJ hiking interest rate itself, right, this is not good, because the past history, when the BOJ increase interest rate, the market will get the hit, and eventually there will be profit taking in equity market. So that is why now the hedge funds are very interesting. They are shorting the yen in the market. So the thing is this, the yen is indeed lowering down. In fact, this is something interesting, because if we compare to what Warren Buffett have said in the June period, he said that the US dollar is going to hell, and in fact, you need to protect yourself. And of course, again, he also did mention in a way that he's going to move a lot of money from the dollar to the yen. So interesting. Who is correct? Would it be Warren Buffett, or would it be actually the hedge funds? All right. So judging from what we are seeing right now, right, it seems that the hedge funds are winning the battle, because the dollar yen seemingly is the yen is weakening against the dollar. So you can see right now, BOJ has been trying its best to intervene to strengthen the yen, but the currency remain at the weakest level because all the hedge funds in the world are shorting it. So the question is this: will there be a point whereby you'll be breaking? So think about this right now. Imagine if the BOJ fail, this is going to be very terrible. And of course, right now we can see that 30-year are actually at a very high level. By right, in this case, it's that the yen should go up, but in it, the yen weaken. So all this thing tells you that the carry yen trade is going to be a very scary thing for next year. And I believe that something terrible could be happening. So we look back in this chart since at the Dow Jones versus the Fed Fund versus the T-note, you can see very clearly that at the start of the time whereby the market, when the Fed Fund cuts interest rate itself, okay, you can see over here the stock market doesn't really react instantly. As a matter of fact, it comes down for a short while and then push up again. And then after that, that's where the real selling comes in. So look back again over here, we had the Fed Fund cutting in, we have the initial dive, and then the market recovered. but then now the sideways happening. You can see that. So will we see the selling if the market break the trend line? I think it is very, very, very possible. Yeah. So traders, you need to watch out for this. And in fact, now not only me saying this, apparently Tom Lee on CNBC says that the 2026 could mirror the 2025 volatility. The S&P 500 may drop by 10 to 15%. Is in line with what I'm looking at the market right now. He also believed that there will be a delayed Fed cut, which is the same thing as what I just said. And of course, the policy is going to be very uncertain. And of course, we have all the arrests. But he also expects a strong recovery in the third quarter. Exactly the same thing as mine. So I didn't copy him because I was saying this for the longest of time. And when I saw this article, I think that, hey, not bad. This guy and mine share the same opinion. So that's why it become a very strong marker right now. Now, the thing is this, we do know that there is a very strong spike here itself on the US treasuries, whereby trillions in the US debt could expire in 2026. Oh gosh. So if this actually happens, there will be a liquidity crisis, and that makes sense why the Federal Reserve is spending money in the system right now, because this is the problem, yeah? But billions of dollars versus trillions of dollar debt, come on, guys. We all know the answer. So because of that right now, right, let's look at the final chart. You can see that this is where the dumb money is. Dumb money is where the retail come in, betting on the market. So right now, they are really expecting the market to continue to go higher. And we can see that whenever this happens, the S&P 500 will take a tumble. So once again, all this tells you that we could see a pullback in the near term. So guys, this is one of my chart here. Take a look. So the thing is this, the Dow Jones have been moving up pretty good, no problem. But recently, we do see a bit of divergence while the boys are buying. Interesting. Now, once the boys start to sell, you can see that when the KSI turns to red, the last time we saw this, when the market basically turns red, right, 2 days before the big sell-off, the market came down by 1,490 points for the Dow Jones. And then it happened again back in this November, where it turns red over here, and the boys were selling. The market dropped by 1,820. So if you ask me this time around where the market could be heading, now we are not trading about 48,353. Based on my KCB, we're going to see the market coming down to 47,552. Now, this is not a lot because it's just about 800 points away. So if I look at it, if it'll be a 10% to 15% drop, we may actually see the market coming down to 45,900 series. Now, if that is the case itself, right, that should be around there, because 10% of 48,000 right now is 4,800 points. From where we are right now is somewhere about 45,000. So I think that this could actually happen next year, okay? Now, the thing is this, again, I'm not being bearish here, but I give you all the numbers and the context, and now with the BOJ kicking in and the hedge funds coming in, all these tells me that something is going to break very soon. So for this GDP that is 4.3% in the third quarter, the market was happy initially, but yet it failed to break new high. This is something that I am having my question mark here itself. So I believe that this one is going to burst the bubble very, very soon, because I don't think that the GDP was actually correct. So guys, thank you very much for watching this video. Share with your friends. I think they're going to enjoy this. Thank you very much. Take care. It's KEL signing off. See you in 2026. Bye-bye.